Our question today is from Max, and he's got a trial balance which lists GST as follows. There's a whole bunch of other items, but what we're looking at is the middle item there. GST Clearing has a credit balance of $3,400. And the question is, what sort of item is GST in this trial balance? To answer that, we've got to have a pool of things to choose from, and they're called the elements of accounting. So basically, every item in accounting can be classified as either an asset, a liability, owner's equity, revenue, or expense. So what we're trying to ask ourselves is, what is that GST? Which one of these items does GST belong to? Is it always the same? Is it different in this question? And let's go back to the beginning to try and figure out how and why. How does GST even work? Well, what it is if you go to a shop or a cafe and buy a Coke for $3, at the register you don't pay $3, you pay $3.30. And the reason why is, when you do that swap, the the 30 cents represents the goods and services tax, or GST, which is 10% of the sale price for most goods and services in the Australian economy. What's important to realise is that when we're studying accounting, we're doing it from the business's perspective. So from the business's perspective, that $3.30 is actually made up of two things. Firstly, the $3 is revenue. That belongs to the company. That's the revenue it earned from selling the Coke. And the 30 cents is actually a liability. It doesn't belong to the business, it belongs to the government. The cafe doesn't own or control that money. That's going to have to go to the government. And how the government designed the GST system to work is it's not what's called a direct tax. A direct tax would be this. You've got consumers buying goods and services and getting charged GST. And then on the other side, you've got the government collecting GST from consumers and then using it to build roads and schools and so on. So what would be a direct tax is if the customer with that 30 cents GST just gave it straight to the government. But that's not even possible. How could you, every time you bought a Coke or any sort of good or service, give the money straight to the government? You don't. And because that's not feasible, what the government's done instead is involve the business. They've said business must collect the GST from consumers, so in this case the 30 cents, and then they must pass that 30 cents on to the government. So from the business's perspective, they don't own the 30 cents of GST, they're just holding on to it for a while until they have to give it to the government. And looking at that 30 cents of GST, it doesn't belong to them, or to the business, it's actually going to be an obligation. So what that means is it's going to be a liability which we create called GST Clearing, and we assume it's a liability. It can be an asset, we're going to investigate that in a minute. But when we collect GST, that is going to increase the liability we owe to the government, so it becomes a credit, in this case of 30 cents. Taking it up a notch, let's say during the month there's a lot of transactions which include GST. So for instance, this business collects GST on its sales, and every time it does that, it increases its liability, which we'll represent as this big pot here. So let's assume there was a sale of $2,000 plus $200 GST. Well, the water level in that pot goes up to $200, and that's a liability that the government owes to the business owes to the government of $200. They might make another sale. So sale number 2 is $1,000 plus $100 GST. So now the water level or the liability goes up to $300. That's how GST works. What we need to remember though is that a business also pays GST to other businesses as well. And when they do that, it decreases their liability. So let's say, for example, during the month they spent $500 on fuel with $50 GST. Well, the water level here will actually go down. It'll go down from $300 to $250. What if they also paid their rent? $1,000 plus $100 GST. Well, again, the water level will go down from $250, and now they'll only owe the government $150. And that's all GST is. At the end of the month, in this case, this business owes the government $150, and that would be a credit, which increases a liability. What about though if the business ends up paying more GST than it collects? Let's just use some examples again. Let's say they have a sale of $1,000 plus $100 GST. The water level in the liability goes up. There's another sale of $500 plus $50 GST. The water level goes up to $150. But what if with the payments of GST this month, they're actually much bigger? What if the rent payment's $1,000 plus $100 GST? Well, this has got a decrease from $150 liability. It's now going to go back down to only being a $50 liability. What if also there was advertising paid of $1,500 plus $150 GST? Well, we only owe the government $50 as a liability. Now that's going to go down by $150. So what happens then? Well, what actually happens is we've kind of got a negative liability. The water level is actually underneath zero. And what that means is we don't have no such thing as a negative liability. What we'd actually do is call that an asset. When an asset goes up, that's a debit. So we would say the GST Clearing account would have a debit balance of $100. So whether GST is a liability or an asset, in this case, instead of a liability, it is an asset, but it's purely different in every question with every business based on how much GST a business has paid and collected. Lastly, to summarize, when you collect GST and it's more than the GST the business pays, you're going to have a liability. So, for instance, using some examples, we collected $300 in GST from customers, but we only paid $150. The business has a liability of $150. So that would be a credit in the ledger, and the water level is up to positive $150. But sometimes businesses collect less than they actually pay in GST. That actually means the GST clearing account will be an asset. So, for example, if we collected $150 and paid $250, we actually have an asset of $100, and the GST is not a liability on the credit side. It's actually an asset on the debit side, and we don't owe money. We're actually going to get money back from the government. So now we can go and answer the question. What we've got is a GST clearing account with $3,400 credit balance. What sort of item is that? Well, we know that's a situation where, and we're just going to make some numbers up here, but we'll say the GST collected is more than GST paid, and they must have ended up with a liability. So let's pretend and make up the number. Let's say $8,400 was collected. They only paid $5,000 in GST. So that must mean this business owes the government a $3,400 liability. And that means in this question, if the balance had been over here on the debit side, the opposite would have applied, and we would have had an asset. So to answer GST, it's a tricky one. It can either be a debit or a credit. And to answer any question involving GST, you've got to know how the liability or the asset is calculated.